From tech, let's now move on to FMCG. And we've got Abneesh Roy, ED at Nuvama Institutional Equities, joining in to talk about exactly that. Abneesh, hi, good morning. After a mixed Q3, do you think that Q4 FMCG is at an inflection point? Can we actually finally see some earnings growth? Because the Q4 updates so far have been quite patchy.
Yeah, so thanks for having me. Yeah, good morning. So if we see, there have been 4 updates in the staples. We have seen Adani Wilmar being stronger than expectation. Godrej Consumer and Marico were in line, while Dabur was below expectation. Coming to a specific question, I would say that currently still, I think the urban slowdown continues to impact. So companies which are more rural focused or which are more in the premium part of urban in the staples, I think they are doing better. Companies which are more in the mass end of consumption, especially in the urban, they will continue to see a soft demand environment. In terms of raw material, I think palm oil, copra, tea, all those continue to be quite inflationary. So as of now, margins will be under pressure for most companies in Q4. I think the demand improvement and the margin improvement will start from Q2. Q1 should be better than Q4, and Q4 also a bit better than Q3 for some of the companies. But overall, in staples, the results will be weak in many of the cases. I think wherever the summer demand is strong, so Varun Beverages should see a strong volume growth of around 12% in the India business. Imami also decent. And we also see Pidilite and liquor companies also see decent number. But from a FMCG staples perspective, I think Q4 will remain challenging.
How much of the Q4 numbers are actually relevant? Because if somebody is giving an outlook, that outlook has to incorporate tariff and tariff impact going forward. And we don't know where the tariffs are. So do you think, irrespective of what the Q4 numbers are, managements will not give a concrete answer? And if they will not give a concrete answer, markets will get nervous.
From an FMCG perspective, frankly speaking, tariff doesn't really matter much. In fact, 3-4 key things are actually positive for the sector. See, one, of course, is from a crude oil perspective. I think clearly it is quite soft currently. It's at a 4-year low. That helps FMCG margins from a packaging cost perspective. A lot of the other raw material, for example, paint companies, Pidilite, for detergent categories also, it is linked indirectly to crude oil. And we will see that benefit coming from Q1 or Q2. Second, clearly defensives are in favor because, as I said, this is domestic consumption. Tariff again, India-US tariff, very little impact on FMCG sector because nothing much is exported to US and nothing much is imported from US, at least for the FMCG company. So I don't see that as much of an issue. For example, in liquor company, there could be a question. For example, in the spirits, Bourbon whiskey has become cheaper from US. But again, those will be in the very niche segment in liquor. The taste is very important to change the taste, to set up domestic manufacturing. Those things take years and years. Importing it from US, yes, it becomes cheaper, but still it will be more expensive than most of the Indian whiskey. So I don't see that really changing from a spirits whiskey perspective. On FMCG, frankly speaking, US tariff, etc., not much of relevance.
Right. So, Abneesh, leave us with your top pecking order from within the FMCG pack. And let me just, put in the entire pool beyond staples.
Sure. So beyond staples, I'll take it first. We continue to like trend. Although numbers of 28% growth looks a bit lower than what they have done earlier. Please note that the base effect does catch up now with trend. And there is an urban slowdown. So if urban slowdown is one by one hitting every form of consumption, at some stage trend will also see that, and it's happening. But 28% growth is still a top tier growth. How many forms of consumption in India currently are seeing a 28% growth? We also like Titan. So yes, gold prices are up, and overall we see market share gains for the larger jewelers continuing. Margins could remain a bit range bound, but that is something from a sales perspective that is fine. And in the QSR, we continue to like Jubilant Foods. Coming back to FMCG, I would say that from a near-term results perspective, Marico, Varun Beverages look good. Imami also looks good. In the slightly discretionary consumption, United Spirits, United Breweries, and Pidilite is something which we like. I think paints could be a good contra call because crude oil has corrected and frankly speaking, Birla Opus has panned out. But what we see is definitely the industry will come back to growth and definitely Berger is looking good in that space. And we also like Nestle. So these will be some of the names where we'll focus more. And rest of the companies, I think from Q2, there should be some recovery.
They say that you don't make money if you buy stocks above 50p above 50 to 60p. All the FMCG stocks, with the exception of ITC and I think United Spirits, everything is 50, 60 times. Will FMCG stocks or consumer staples actually make money?
So two things. One is if you see because of the FI selling and because there is an urban slowdown, we have seen the valuation correct. For example, Nestle is a good barometer. It is generally the most expensive FMCG stock. It used to generally trade at 65 plus P multiple. Now it is definitely much lower than that. And that I think is applicable to most of the FMCG companies. Of course, in the last few weeks, some of these names have come back strongly. Marico, for example, has come back strongly. Pidilite has remained strong. Liquor stocks have also remained strong. But someone like a Nestle, for example, or say even Britannia, for example, the wheat crop is not looking as bad as initially. The monsoon forecast is good. So as you rightly said, Nikunja, outlook also matters. So outlook from a good monsoon, outlook from a raw material crude being soft are good. And definitely April salary, if you see the first tax rebate kicks in. So that again will help all forms of consumption. Our view is FMCG will gain later. Initially, my sense is it will be more discretionary, which will gain, for example, travel, hospitality, maybe even education. A lot of consumers will retire their home loans and auto loans, etc. But ultimately, every form of consumption will gain because let's say it's a 1 lakh crore tax exemption being given by the government. It's a large consumption boost. So that should also help. And definitely tariff order, no much impact. It's a defensive sector. It's a dividend yield. So all these will make defensives back to flavor. So we will see that happening. So that should support the P multiples going back. For example, Nestle, as I said, now more like a 50p multiple. It used to trade at a 65p multiple. It will take some time, but overall, a lot of the fundamentals are improving for the FMCG sector.
The other trigger point for the consumption basket was the budget announcements, what we have seen, and the cuts in the tax slabs, and that's expected to do bode well for the consumption basket. But help us understand, by when do you expect that trigger to start reflecting in the volumes?
Yeah, good question. So if you see, urban slowdown for FMCG started broadly in Q2 of last financial year. So we are still maybe in the third quarter of that slowdown. And my sense is even in Q1, the urban slowdown will continue to remain. Now, urban slowdown happened because of four reasons. Some of them have improved. Some are still remaining as a problem. If you see, food inflation has cooled down. All those high tomato, garlic, and palm oil, etc. Some of those have definitely cooled down. So that is positive. Second, as you rightly said, the 1 lakh crore kind of a salary tax benefit that also should start from April month. But initially, it will go towards more discretionary and maybe retiring the home loans, auto loans, etc. Third is the rents have gone up really a lot. There we are not seeing much of a good news. But fourth is on the EMI front. Now two interest rate cuts have happened. So 50 bips cut has happened. So I think some benefit should happen. Now, one more aspect is if you see the urban slowdown impacted QSR, etc. before FMCG. So QSR, for example, the slowdown has been more than 8 quarters now. So difficult to say whether in the base effect, say from Q2, the recovery starts. Currently, it's a bit of a hope. So I will bet on companies which have market share gains, which have the better innovation funnel, etc. That's why Nestle, Marico, Pidilite, Britannia, etc. will be the more preferred bets within the broader FMCG. But for overall mass consumption in FMCG, I think Q3 is where the real recovery should start. That's how we see.
Right, but Abneesh, also give us a sense, what are you observing within the quick commerce trend? The reason I ask is that some of the listed players have corrected sharply given the growth concerns, but along with that, the competition seems to be increasing in this particular space, and recently we have also seen some companies announcing layoffs. So help us understand, what trends are you seeing shaping up within the quick commerce space, and how comforting the valuations are at this point in time?
So one caveat, I don't cover those companies, so I can speak more from a FMCG and consumption perspective. Yes, competitive intensity in that space is high. That is in fact a good news for FMCG because the bargaining power improves for FMCG, that they are having more partners. Yes, Kirana is losing market share in some of the big cities, for example. Our sense is modern trade, e-commerce, quick commerce is now very large chunk of the consumption, and Kirana is losing market share. So I will say that yes, overall this trend will continue. The consumer is looking for convenience. Currently, discounting and pricing is the reason why I think some of those layoffs which you mentioned, I think the unlisted players, Zepto is very aggressive. That could be one part of the reason that overall urban slowdown is there. And then we have competition in that space. But I will not be able to comment on the listed names in that space because I don't cover it.
We do take note of that, but with this, we let you go on that note. Thank you so much for taking the time out and speaking with us this morning.
If you like this video, then like, share and subscribe to ET Now.